Welcome to Bloomberg Quint. We're in the Bloomberg offices in Midtown, New York. And I have with me Krishna Memani, the Chief Investment Officer of Oppenheimer Funds. And Krishna just tells me that Oppenheimer has about $5 to $6 billion invested in India. So we're going to talk to him not just about the world, but about his take on Indian equities and the Indian debt market. But before that, Krishna, you've been writing notes that refers to this period of time as the century of central banks. I get the central bank focus. I don't get the century focus. Are you suggesting that we're going to see another 90 years of this?
Well, I'm trying to make an exaggerated point, which is central bank involvement in financial markets is going to be with us for quite some time. And it'll be a lot longer than what people are anticipating, because we are in a bind on a global basis where we have deep or very high levels of leverage and slow economic growth. So central banks are critical, and they will be part of the capital markets for a long, long time.
All right. Do you see any of these central banks having achieved any degree of success in fixing what they began to fix? With the exception of maybe the Federal Reserve, which a few people seem to be a little bit more confident about.
Well, so it really is a question of defining what success is. If success was going to be that central banks on their own will be able to revive growth on a global basis, that was a very unrealistic expectation. I think coming out of the financial crisis, the first thing the central banks had to do was to make sure that we don't get into a deep economic hole. And in that regard, they were phenomenally successful. Subsequent to that, they have stabilized the market. So they have succeeded partially, but even if you push them, even if you ask them, they will tell you that the likelihood that they on their own will be able to fix the demand side of global economy, which is what truly ails us, it's not realistic. So,
well, what would you define as a deep financial hole? $5 to $7 trillion globally are currently quoting at negative interest rates. Is that not a deep financial hole?
No, so deep financial hole would have been if the U.S. economy had contracted by 5-6 percentage points. So it's the deep financial hole would be when the overall we faced depression. Okay. And we certainly don't do that. And in the financial crisis, if they hadn't taken very concerted and proactive actions, that was the true risk. I distinctly remember having conference calls where we were trying to figure out how the banks will close for business on a global basis, and how would things work out in Japan when the sun rises. So all of that didn't happen, and I think that's because of central bank intervention.
And we're still seeing central banks in Europe, in Japan, having moved from buying government securities to buying corporate securities. I think one recent note you mentioned that every large central bank will end up buying credit assets.
Yes.
Where is the solution in sight?
Well, again, the key point in this regard is central banks alone cannot solve the demand deficiency problem that the world faces. So what they can do is hold off the worst case scenario for as long as they possibly can, until politicians come together to take concerted fiscal action. When that would happen is an open question at the moment.
Okay, so this is the macroeconomic context that I wanted to set before I asked you about asset classes.
Sure.
Just one more macro question, and that is, I think you were not necessarily a believer in the fact that the Fed will hike rates anytime this calendar year.
Yes.
You thought that the chances of even a December hike were very slim.
Yes.
Do you still hold on to that, or have you changed your mind? And, do you think the elections in the U.S. will play any role at all in determining which way the Fed moves?
No, I think the Fed is independent enough for it to make policy decisions primarily based on what it believes the economy requires.
Okay.
And so elections are really not a critical point. I would say my bet is still that they don't do anything in December, whether they, we'll see how that turns out.
Why do you still believe that?
Because I think they are still data dependent. And my expectation is the data in the U.S. in the fourth quarter is actually going to slow rather than re-accelerate, which is what needs to happen for them to do anything. If you look at some of the nowcast numbers that you see, we are talking about 1.25%, 1.5% type growth in the U.S. in the fourth quarter, and that's not an environment where you tighten policy.
So do you expect that the rate hike will just get pushed down by a
Yes.
quarter to maybe
Yes.
the first quarter of next calendar
Yes.
year?
And
or do you think it could be even longer before
so
the next
that,
rate
I
hike?
think initially that's what they would say. My position would be that the likelihood that the Fed raises rates in a concerted way, they may do one or two at some point, but the likelihood that they raise rates in a concerted way is very small. And if they do that, they will basically take down the U.S. economy.
Okay, so essentially the liquidity tap will stay open across the world. And in this context, we've already seen, what asset prices have done, especially in equities.
Sure.
Do you feel confident that if this were to be the case with central banks, that equity prices would continue to rise, whether it's in the US or in emerging markets like India?
Absolutely. So our recommendation is that global equities is really the place to be for long-term investors, because this environment is reasonably conducive for those asset prices to continue to go up. And we believe the best opportunities are in the U.S. because U.S. is really where, of all the developed markets, we have the best growth potential. And secondly, emerging markets, because the valuations in emerging markets, they used to be extraordinarily cheap. They're not anymore. And places like India, they are not at all. But other emerging markets, valuations are quite attractive. So a barbell of U.S. and emerging markets.
And in another note, you say that the allure of value investing will soon fade. So what shift are you indicating will take place in the way investment flows continue to chase equities?
So if you remember, what had happened was after February, or a big correction in February of 2016, some of the value equities did very, very well. So commodity producers, oil producers had a very substantial rally. And the thinking was, because of that rally, the attractiveness of value will continue. My point is that is already done. What we are dealing with in this world is the fact that growth is missing. And people are more than happy to pay a good premium for that potential growth. And therefore, value recovered from a very deep drawdown. But going forward, it will still be really about growth. It'll be about things like tech and internet and Chinese consumers and things like that.
So where does India figure in this, Krishna? Because unless you have great confidence in a big earnings recovery, the signs of which we haven't yet seen, it's been very moderate, where is the growth to buy into at this point in time?
So India is very...
And is it not already too expensive?
It is indeed. India is the place where everybody who wants to invest in emerging markets but is very scared of investing in emerging markets is basically hiding. And that has been the case for quite some time, because it is the safest bet in emerging markets. You have, the country is growing at a reasonably rapid pace. You have policy support and the potential of structural reform, something that we talk about, as you mentioned when we were talking earlier, every 3 years with respect to India. And that has attracted significant amount of flows into India. Whether that will stay that way, I think, again, is an open question. For now, India is a safe bet. If other emerging markets start growing at a better pace, or if India fails to deliver, I think that equation may change.
Okay, we can't tell what the rest of the world will do, so let's talk about what Oppenheimer hopes to do in India.
Sure.
Are you going to look to put more money to work in Indian equities? Is there any element of the debt market that continues to look attractive to you?
Sure.
Where are you putting your money to work in India?
So, as I mentioned before, we have substantial investments in India already. We have been doing this for decades.
Yes.
And if we find company-level opportunities, then we focus far more on companies than countries itself.
Sure.
We will continue to do that. Having said that, as I mentioned also, valuations in India are not cheap by any measure, and therefore the attraction of India as an equity destination at the moment, for us anyway, for long-term players who go by valuation, focus on valuation a lot, is kind of tough. Having said that, I think the fixed income markets in India are kind of very attractive because here you have a situation where the central bank has credibility, the inflation problem is fading to some extent once you strip out, food prices and things like that. So, if the policy imperative or if inflation continues to go down, the likelihood of rates coming down in India are quite substantial. And therefore, from a fixed income perspective, India is one of our favorite markets in that regard.
So are you increasing your bets in the fixed income market?
Yes, we use lots of vehicles to make that investment. We don't necessarily have to go out and buy bonds in the Indian markets. We can do that in derivatives, but we have reasonable positions in Indian fixed income markets, and we continue to increase our position in the Indian fixed income market.
Okay, now that you've mentioned that, and broadly the Indian fixed income market is the government securities market.
Yes.
There have been some recent efforts by the government to deepen that and deepen the corporate bond market.
Sure.
Would that be an attractive investment avenue for, let's say, funds like yours, where you feel that, okay, this is the appetite we have for government securities, but corporate bonds also do look interesting, specifically a few companies and a few sectors, we might continue to chase that?
Absolutely. And here's the logic. We believe this low return environment, low interest rate environment will be with us for a long period of time. So looking for new opportunities to invest debt capital is something that we spend a lot of time on. Unfortunately, there aren't too many very large corporate markets out there where the probability of that market getting created exists. China is one, Brazil is the other. However, both of these countries are kind of dealing with very specific structural issues. India, on the other hand, this would be great. I think if the Indian capital markets, especially in the corporate sector, deepened and the size and the liquidity increased, I think you will see significant amount of flows from overseas investors in rupee corporate markets as opposed to just the dollar Indian bond markets.
So you wouldn't just be shifting money, you'd actually be adding new money to
Absolutely.
To India. If this
we
was
are
the case.
Looking for opportunities like that all over.
Okay.
Where we think we can invest and where the liquidity problem will not end up, or liquidity would not end up as being a bottleneck. And I think if the Indian capital markets developed, we would certainly consider it.
But that does sound like it might be some time away, not immediate at this point in time.
Yes.
Immediately, let's say over the next 3 to 6 months, do you envisage putting more money to work in the equity side of things?
Probably not, as I mentioned before, probably not on the equity side, because
more
it's
likely in the fixed income side.
More likely in the fixed income markets, yes.
Okay. When you look at India at this point, do you feel that we've been able to deliver on the promise of the Modi government when he came in 2014? Yes, the government's made several attempts at restructuring GST, which is currently the big headline in India, continues to dominate the headlines, has been a big talking point. But we still are stuck with an endemic NPA situation, a non-performing asset situation. Inflation always seems as if it's just under control. We have a new central bank governor whose first policy announcement will be in October, the first week. What does India look like to you from here?
So, it's a question of half full, half empty, right? That is
always.
There are lots of positive things that you can look at, and if you want to, you can scare the living daylights out of yourself by looking at all the negatives. I think India is in a pivoting point. That is, if it can deliver some structural reforms, I think the likelihood that foreign investors come into India, either in FDI or portfolio flows, in a big way, the likelihood of that is probably as large as it has been at any point, for one simple reason. Actually two reasons. One, there's plenty of liquidity on a global basis to be deployed in good destinations. And second, India's biggest competitor for capital flows was China. And China is kind of in a corner itself. So I think the field is open. If the policymakers can just deliver, and they don't have to deliver the whole package in one day. As long as they can continue to make progress and demonstrate to foreign investors that they're moving forward, I think the equation can change quite rapidly.
Is it therefore part of your estimation that we will see at least the key indices in India move higher from here and from these levels, or you don't look at the markets from that point of view and more from a stock-specific point of view?
Yes, for us, it's really more about specific companies far more than the countries and the large stock exchange indices. We buy companies that we are going to hold for 10, 20 years. So it's really very company specific. Having said that, I think what people have to remember is that Indian markets can't be just in Indian context. There has to be a global context to it as well. So for Indian markets to continue to do well, equities overall on a global basis have to continue to do well. That is our expectation. That may happen. But if that is not how things pan out, then Indian markets can't just continue to go up on their own.
So next year, if we were to meet again at this time, Krishna, would you expect that the Nifty would be way above 9,000, the Sensex somewhere close to 30,000, as some calls are making now?
Absolutely. I don't know the magnitude. We can debate that. But my expectation would be higher rather than lower.
Okay. So one quick last question then. What is going to change your fairly bullish outlook on equities and the fixed income market in India? What are the potential party spoilers here?
So a few of them. One, basically global shocks. So whether it is policy shocks, it's some form of Brexit in another country, politics in the U.S., things like that.
A Trump presidency?
Trump presidency initially would probably be somewhat disconcerting, for sure. I tell people Trump is like Brexit for the U.S. Not because the policy implications are that bad. Actually, if he brings down brings in fiscal policy into play, that may actually help. But the uncertainty itself may end up being quite a drawdown in the beginning. Having said that, I think for India, the real question is whether the policymakers do all the things that everyone expects them to do. So if Mr. Patel moves away from what the path that was chosen by the previous governor, that is going to be a problem. If there is a significant issue with respect to politics and how BJP plays all of this out, that may end up being a problem. So a lot of it is under Indian control, and some of it is not under Indian control.
Krishna, thank you so much for your time. Thank you for speaking to us about India and for being here on Bloomberg Quint.
Yep, thank you very much.